Good morning, ladies and gentlemen. On behalf of my colleagues at Personal Trust, I would like to welcome you to our webinar this morning. We are very privileged to have Sandy McGregor from Allan come to have a chat with us this morning. Sandy is a very experienced investment professional, having been with Allan since 1991. Today, he will be addressing some of the topical issues with which the market is currently grappling. For example, inflation, is it permanent or transitory? What's the likely Fed's reaction to the rising inflation that we've recently seen in the USA? China, is it moving towards an even greater command economy, with particular reference to the impact on NASPAS and process? The tremendous commodity price boom that we've seen first 6 months of this year, how's this impacted South Africa's fiscal crisis? When will the South African Reserve Bank potentially increase interest rates? And some comments around the most recent political response to the riots that we saw a few months ago. So Sandy, without further ado, if I could hand over to you, and we really look forward to your presentation today. Thank you very much for being willing to present to us.
Right, thank you, and good morning all. I'm just going to talk about a few things I'm thinking, which you heard, things that sound important at the moment. And it's really, you know, when George Marshall was US Secretary of State, he was regarded as being very effective, and his successor was asked, why was he so good? And the answer, Acheson's answer was, he knew what was important. And I think this is the key thing in investment. We've got to identify actually what is important. So this is my selection. Of course, the trouble is everyone has their different selections. That's why we all get confused. But to start off with, talking about how we're coming back to normal after the pandemic, we witnessed a remarkable supply chain disruptions, and I think what most people didn't realize as we entered the pandemic was how we get wave after wave after wave, and the latest one, the Indian variant, Delta, being sort of much more virulent than earlier ones. And we've seen shortages develop throughout the global economy. It's been very difficult for us to get back, for countries to get back to normal. The most classic one, which we've all seen, is the shortage of computer chips, which go into everything nowadays. And so you get a company like Toyota the other day, the world's largest motor car manufacturer, suddenly announced it was cutting back production by 40% because it didn't have computer chips. Been running on its inventories since last year. And they've run out. And this is a feature of this supply chain disruption. What happens is that people have things in inventory, they run out, and then the problem starts because they can't be replaced. We see this disruption very dramatically in shipping. And it's important for us in South Africa because in a way everything in South Africa comes and goes by sea. Well, maybe some by air, but you know, sea links is a vital part of the supply chain for us. And you can see how the Baltic Freight Index has surged since last year. Now, I put in a longer graph just to remind us that you know things haven't gone to anything like they were in the shipping boom of 2007-8. But also, all the same, you know, the shipping rates have more than doubled, tripled, and ships are just sitting outside ports, unable to get in. There's a big shortage of containers, and so supplies and things are not being delivered, and this is sort of having a domino effect through the world economy. We see the disruptions in commodity prices. This is the metals index. You can see that it's doubled since its low of last year. And again, we have very strong demand in China and elsewhere, and the mining industry is battling to meet that demand, and prices are are very high. And again, the disruptions caused by COVID aggravate this situation. We've got food prices. The inputs to food have increased by 50% since their lows last year. And the food story is an interesting one because it's more than it's not just the pandemic, well, that has some contribution to it, but the two themes in food which come together. One is that we've had a very strong growth in demand because China has become a major importer of food. This, by the way, is called a great opportunity for South Africa, South Africa's farmers, because it's transformed export markets in our favour. But the other thing that's happened has been serious weather events, specifically in Brazil and in California. California produces more than half the world's tomatoes or something. So if there are no tomatoes, if California has a drought, there are no ketchup, and America grinds to a halt. So this disruption of food index, food supplies is also a problem. Now, what you've seen as a result of this is that the inflation rate in the United States has shot up to above 5%, and this is the same level was briefly at in 2008, and then after that, before you've got to go back really to 2000 to early 1980s to get similar readings. And the impact in America has been far greater than elsewhere. If you look at the inflation in Japan or in Europe, in Europe's running about 2%. But the US has got this surge in inflation, as I say, which was totally unexpected by the monetary authorities, and the big debate about it is whether it is transitory, as the Fed is saying, many people in the market, and whether it is more persistent. And interestingly enough, I was listening into Jim Bianco, who's one of the people in the world you should listen to. Yesterday, he was saying that 2/3 of the market in America, 2/3 of the market believes that it's transitory and 1/3 is persistent. So that the market is still seriously ambivalent about this matter. But when you look at the inflation that caused this inflation, there are these disruptions of the supply chain. But there are other factors which have come in to it. In real estate is a serious part of the housing, is 40% of the American basket. And the pandemic has changed people's attitude to renting and owning houses and caused quite a serious property boom. And rents have been rising very rapidly. And that again is a shortage which could be quite persistent for some time. So although some of the transitory phenomena like lack of goods, like lack of cars, for instance, which are pushing up the price of second-hand cars, go out of the index, other things come in to replace it. And this is characteristic of a persistent inflation. The other remarkable thing is the shortage of labour. But the business vacancies in the United States are the highest they've been in decades. So companies can't get the people they want to work for them, to come and work for them. Getting back to work is proving very difficult. And it's not only in America. For instance, in France, the restaurant industry is finding it very difficult to get people to get open again because they can't get people willing to work in the way they used to work at unsocial hours. So the whole system has been disrupted. And you're seeing it adjusting through higher prices, higher wages, and so there are strong grounds for arguing that it is actually persistent. But as I say, the Fed is thinking otherwise. But it's starting to blink. And to understand where the Fed is now positioned, it's worthwhile just to go back a bit in the recent history of what it's been doing. After the 2009 financial crisis, they put rates at naught and embarked on programs of QE, which is polite word for printing money, and that persisted until 2015 when they started to taper. They first tapered. They stopped buying assets, printing money, and then after 2015 they allowed interest rates to move upwards. And interesting enough, as you entered into 2018, the guidance at the end of 2018, the guidance they were giving was they expected rates to end up at about 3%. But the problem was that the markets were getting very nervous about this, because actually the whole process of cheap money has made stock markets go up enormously. The whole programs of QE did nothing much for the real economy. They've done wonders for asset prices. And the markets, especially Wall Street, got very nervous about something ending something which has made us all so rich. So there was huge pressure on the Fed to stop, and it did. It stopped raising rates, it started bringing them down. And when we got to the pandemic, it brought them back to zero again, and it reacted to the pandemic first in March last year very effectively to stabilize the world economy, which was suddenly in freefall. But after that, they continued, they've injected since then $3 trillion into the economy, buying assets. And but since the pandemic, so the crisis of March, April, they've been buying assets at a rate of about $120 billion a month. And that's, when you look at Wall Street going up, well, that's what's making it go up. And the question is, when was this going to end? Well, they previously were giving guidance that it would be 2023, 24. That was why this thing was QE4, it was QE forever, because there was no sense that it would ever end, and they just go on at zero rates of printing money forever. Now, with this surge in inflation, many starting to have doubts about whether it is wise to enter a period of extreme inflationary pressures with interest rates at naught. Normally interest rates should be roughly equal to the inflation rate as a good guide, and they're clearly not now. And so there is a huge pressure now on the Fed now to stop tapering and so that it can actually then push up rates in due course, to have some ammunition. If inflation is not transitory, they need to position themselves so they can handle it. And that's the argument for imminent tapering, which there will be statements that Jay Powell will be speaking at Jackson Hole this week, and he's likely, we'll see what he says, but I think the sense is that the Fed will start giving guidance fairly shortly on a program of tapering, which could start as early as October, November, maybe November, and going down about 15 billion a month. So instead of doing 120, they do 105 and 90 and so on. And it takes 8 months to end the asset purchase program. And that's a major issue of importance to markets, because I say it's the petrols, the fuel, that's driving up this equity market. And once they've finished tapering, then they can start contemplating increasing rates. You've got to do the one before the other. One of the arguments of the people who believe inflation is more persistent is the change in the massive increase in US federal deficits, fiscal deficits. Now, Trump started this process. He brought the deficit down to about $1 trillion a year. That's 5% of GDP. He did this by tax cuts. And then there was a huge injection of money, which following the $4 billion deficit, which is 20% of GDP, as a consequence of the pandemic. But in normalizing it, Biden has very ambitious spending programs, which are now a subject of the subject to the legislative process in Congress. And he has razor-thin majorities in Congress. So how this is going to pan out will be very difficult to say. But what you do have is great determination in Democrats to push through a major spending program and accompanying it with some degree of tax increases. But the way the world works, the spending is easier to get through than tax increases. So the budget deficit looks as if it's going to increase more. And you must remember that this is the most radical Democratic administration America's had since the New Deal. And with to preserve power in the midterm elections in next year, the strategy seems the Democratic Party wants to overheat the economy and rev things up, so everyone has a job and everyone's feeling good and making money and so on, so they all vote for them. And that, of course, is a classic democratic program with a small d for inflation. So the fiscal risks causing inflation are very real, and that's why we should not ignore those who say the thing will be persistent. What does the stock market think of this? This is an interesting question. And is inflation good or bad for the stock market? Well, my take on it is shown on this graph, where the red line is the earnings yield of the S&P and the green line is the 3-month Treasury bill rate. There's the same axis. And you can see that between 1980 and really 2008, they marched in lockstep. It was quite rational. The market priced itself off the interest rates, and that was quite a rational relationship. But notice there have been two major periods of divergence of this, and that was in the 70s when the interest rates were too low, and the stock market was signaling a much higher rate was needed. And again, since 2010 and 2010, this has been the case. And what I think it is that when interest rates are distorted by official actions, like have been in the last decade, the stock market doesn't price itself off where interest rates are, but really prices itself where interest rates should be. So the earnings yield on the stock market is an indication of where, in fact, rates should be. And the market is saying 3% is where they should be. And interestingly enough, that was the target of the Fed when it was, before it stopped raising rates. That was the target they were talking about. So we can talk of, in an inflation environment, easily having rates up to 3%, which is a major change in asset prices and impact on it. But it doesn't necessarily mean it's a total disaster for equities, because it's actually bringing rates back to where they should be rather than where they are. That's not to say I don't say prices are expensive. There are other things can bring down the market, but it's not inevitable that interest rates will be the cause. So that's what's going on in America. The debate is about, is this thing persistent or not, this inflation? Now, what about China? And huge changes are happening in China and have been actually happening for the last decade. And that change started when Xi became leader of the Communist Party. But what sort of put Xi firmly on the path to actually move away from previous policies were events in 2015. What had happened was that from the 1980s onwards, under Deng, set China on a path where essentially a free market, a market economy developed, largely unregulated, which was incredibly successful in transforming the Chinese economy. But when we got to 2014-15, there was strain starting to show in this system. And we had the stock market bubble. You can see it there very dramatically, the big bubble that happened in 2015. The market, credit driven, surged up and then collapsed, causing quite a lot of chaos in the financial sector. We also had a botched devaluation, of the renminbi, which caused $1 trillion. China lost $1 trillion of reserves, and there were other problems which were emerging in the system. And this was a signal to the Chinese authorities and the Communist Party that they had to start reining in and controlling the market economy in ways which they hadn't been doing it up to then. And you must remember that Xi's primary objective is the hegemony of the Communist Party in China. Everything else is secondary to that. And the market economy was going and behaving in ways which he judged as not in the interests of the Communist Party. People were making decisions he didn't like, and those decisions might be right, but he didn't like them. And one of the features of an economy which regulators and bureaucrats and communists love is stability. And the market economy is inherently unstable. And that's its strength. You know, if a company is doing something wrong, think of Steinhoff or Enron or something, they go bankrupt the regulators like to keep these zombie companies alive, fearing the consequences of the adjustments which going the wrong path, imposed rapidly through a market economy. So this process of control has been going really asserting it from 2015 onwards. One of the things they reined in was the shadow banking system, which was a major weakness of the Chinese economy, because they controlled credit, but they didn't provide enough to the private sector. The private sector had started its own banking system outside the regulations. They brought that under control, and that's one of the reasons why when Alibaba wanted to list Ant Financial Services, the major objection to it was that it was a huge micro-lending company was being formed, which would totally take the banking control of the banking system away from the Bank of China and the authorities and so on, and that they were not going to allow Jack Ma to run Chinese economy. So this assertion of control, you see it in what's happened with Naspers and with all the tech companies. This assertion of control, though, is part of a very fundamental shift in China, away from being a market economy to being a command economy again. And the thing about being a command economy and regulation is, once you regulate something, it doesn't work. So you have to, and the answer of a bureaucrat to regulation failure is more regulation. And so the thing actually, that is actually in the long run very dangerous for economic growth. And China is slowing down, not so much because of what the government's doing on this, but it's a natural process. One of the things they wanted to do in 2015 was kill the bank, get the credit growing, the money growing the same speed as the economy. And the economy has grown at sort of 10% nominal since then. So they succeeded in doing that. And that was where the control of the shadow banking system was so important. Now they let things go a little bit in 2020, but now, and then they allowed matters to, they've tightened up again. But interesting enough, the economy is growing quite a bit slower right now than I think they really expected. So you could see more monetary easing as a result of this. But underlying strategy is that's a temporary thing. They want to bring this whole credit-driven economy under control. And what it all comes to is that the great China's growth is going to slow inexorably down to make it a more normal country in the next 5 to 7 years. And you'll find it growing at 2 or 3%, not at 6 or 8 at the moment. So major change in China, and that has effects on the demand for commodities, and it affects us profoundly. Now, the commodity boom is of profound importance. And just one point I'd like to make before talking about that is, this is our share market versus the MSCI Emerging Market Index, both in dollars, same scale. And you see how the market move in lockstep. And the important thing to understand from all of this is that we are a normal emerging market, and the way the transmission mechanism of the rest of the world to us is through our trade and through our imports and exports. That's how the world affects us, and also through capital flows. Those are the things that happen as a result of our being a normal emerging market. The flows come into emerging markets, we get some of them. When trade grows, we benefit from that too. So it is the international economy which is the underlying force which drives our domestic economy. Now, the last few months, the last year has seen an astonishing commodity boom, which you can see the scale of it. This is our top 10 exports, which admittedly does include motor cars, which for some reason the people in government thinks is our commodity. But this is our top 10 exports, and most of them are commodities. All of them except cars, I think. And you can see we were running about 40 billion rand a month in 2019. We're now at 71 billion rand a month. So that's 30 billion rand a month increase. That's 360 billion a year. That's 7% of GDP. It's a huge increase in our export revenues. And when people talk about the economy is not growing, well, bits of it are growing very strongly. Other things are not doing so well, and that's why the economy as a whole grows much more slowly. But also, the whole way economists talk about growth is in quantities rather than in value. And really what matters value. The real world that economists talk about doesn't exist. It's the world of the real world, the one that matters is the money and values. And this is has changed quite dramatically to the advantage of South Africa. Now, this is that graph. This is the graph of our exports expressed in dollars, going way back to the start of after 1994. And you can see how immediately after the first sort of 7, 8 years after 1994, our exports were flat and the economy was just flat. It wasn't doing anything. Then China entered the world and created this great commodity boom. And that drove our exports up from about $30 billion to $114 billion. Now that's an enormous change in our economy, and that's what this big boom in the first decade of this century in South Africa was based on. It was leverage of commodities. Everything in South Africa is a commodity share. Woolworths is a commodity share. So, but that growth dynamic, which made the economy grow so strongly, came to an end in 2011 when China went into a slowdown, and as you can see, then they sort of came right down in 2016 with the major bust of the commodity companies. There was a recovery which we didn't participate in because of the Zuma years. The corruption just overwhelmed anything else. But since the pandemic, we've had this surge back in exports back to the levels of the previous peak. And that's very encouraging for our growth, our economic prospects and our ability to grow the economy. One of a necessary condition for us really to grow the economy is a strong external sector, and that we have. And so the key basic building block of recovery is actually in place. And here's our current account surplus as a result of that. That goes to the first quarter of this year. It'll continue in the second and third quarters being in surplus. And you can see you have to go back to the days before 1994, when South Africa had to run a balanced trade deficit because it didn't have any money. It was denied credit by the rest of the world. But since then, since 1994, we've run perpetual deficits, and this change is something we haven't experienced since in the age of South Africa, of the new South Africa after 1994. So it is a profoundly important difference. The mining industry is really booming, but also you mustn't forget agriculture is also an important multiplier on the economy. The farmers are doing an amazing job, and it's the sort of unsung, really important part of our economy which people don't pay enough attention to. Agriculture is very important, and it has an integral multiplier effect on the economy. And in consequence of that, the rand, that's the real rand. Once you adjust it for inflation, that's the rand. And you can see it's really since 2014. It was strong when the commodity boom happened, but you can see in 2010-11 it started weakening. That's when the commodity price went down. But it sort of stabilized after 2014 as the commodities came back at about 14. And that's where it really should be. So the present rand weakness is entirely due to the surge in the dollar, because if US rates are going up and Europe remains down, the dollar's strengthening. People are moving money into dollars. That's why the rand is weak at the moment. It's not really rand weakness, it's dollar strength. But one wouldn't expect a major blowout of the rand in this environment unless there's some really crazy thing happens in politics. And it should be fairly stable at sort of current levels. So when this rand stability means inflation will be benign, and here we see the repo rate, the red line, and the green line is our inflation rate. And you can see since 2015-16, they've consistently had serious real rate, which brought down the inflation rate came down. And with the pandemic, they cut that rate in half. In 2019, there were some of us saying that we should recalibrate. Rates were basically too high in South Africa. Well, the recalibration happens through the pandemic. We're now at 3.5%. The question, where should rates go now? And the inflation expectations and forecasts tend to hover around 4.5%. And if the world is a bit more inflationary, that might not be a wrong view, because we are, I think, have joined the rest of the world in our inflation rates, and so if the world is going up, we a typical emerging market, maybe 4.5%, 4.5% is sort of rate where you'd happen. But clearly rates are too low now for that, and so I'd expect if the Fed starts renormalizing, I think the SARB will start following suit, and that will be the signal. Actually, the signal will not come from South African economy. The signal will come from what's happening in global interest rates. The Fed will, if the Fed starts pushing up rates, I think the SARB will start following suit and perhaps end up at another 1%. Now, rates at 4.5%, that might be the right place to be. So we should see some rise next year in interest rates. But that debate is still going on in the SARB. I think clearly what the debate hasn't reached a level, they don't think rates should go down anymore. It's really about when they should go up and how much they should go up. That is just a question of a journey you go on, you don't stop till you stop. And one point I want to make, one of the things that we have in South Africa is a huge fiscal deficit, which is crowding out the private sector. So although short rates are incredibly low, the long rates remain persistently high, and that's because the entire savings pool is heading into funding the government. There's no spare money around, and that's very bad for economic growth. That's a very bad thing for growth in the economy. Is that the reason why the economy did well in 2000 and the first decade of the century was the GEAR program policy, which was a triumphant success, put the government really into surplus finally, and the government wasn't commanding all the country's resources, the private sector was, and that's why everything grew so strongly. We're not in that situation now. The government is really grossly too big, and we have these very high real interest rates as a result of that. And our real rates, therefore, in this environment remain very high. They've come off a bit now as the inflation has surged, but if you go to a normal 4.5% inflation rate, you're talking about real rates heading of 4 to 5% into the future, which are very high in world terms. So we have a high rate interest rate economy, but you can't do much about this rate because the government fiscal deficit is so big. The last thing I just want to talk about is that what happens with this fiscal deficit? And the July disturbances have had quite an important impact on them. Here's our fiscal deficit. You can see after 2018, it the government lost control of the fiscal deficit, and it just head up and up and up. This is the monthly deficits. But you can see that they reached a situation where, in fact, the budget expected, the February budget expected the deficit to come out at 9.3% of GDP. Now, they totally underestimated the revenues. The Treasury has persistently underestimated the impact of the commodities boom. We're very behind the curve on that. But the thing is that with the commodity boom and the much bigger tax revenues coming from and the leverage on the economy of the export boom, you're getting revenues being much higher than expected. And probably if they stuck with the budget, the spending program, the budget would have come in below 8% of GDP, which is much better. 7% of GDP, which is much better than they thought it was going to be. The present spending program probably heads that back towards 8%, but the additional spending as a result of the disturbances. But we still have a very large deficit, and the correct policy to get rid of this deficit is take this commodity boom, keep fiscal discipline, and get the deficit back below 5%. Anyway, that's still a big deficit. It should really be about 3%, 3 or 4. But but that discussion is really the big discussion in government now. How big, where should we be on fiscal deficits? And there's enormous pressure which has been increased by the disturbances on the issue of basic income grant. Now, one of the problems with Ramaphosa is the government seems to go all over the place. It doesn't. There's no coordination of this. The Treasury used to be a very powerful instrument of coordination, but the Zoom administration gutted that power. It's never really come back. And we've seen when Lindu Sisulu produced her package saying that the basic income grant requires a 10% levy on incomes. This was, of course, I think it's about right. The trouble is income tax can't pay that because, in fact, you reach the limit of what you can extract out of the system with income taxes. As Dennis Davis says, if you put up taxes on the wealthy, they head either to the golf course or the airport, and you don't get more money. The only way you can raise more money is putting up VAT. And if you do the social grant on the scale which has been recommended by proponents of us, 1,280 Rand a month, you end up with need at least a 10% increase in VAT, which would decimate the economy. So we're coming to a major political debate on the role, what should be done, and the simple answer is, which the new Minister of Finance is quite clear about, is the only way to solve the problem is to grow the economy. But these events of this last month has weakened the radical economic transformation faction in the party. It's not really what you were meant to do, it's try and cause a revolution. And has increased Ramaphosa's power in the party. But the difficulty comes to Ramaphosa himself. He is a very cautious leader, and he's a bit like Hamlet. He hesitates, and that is the dilemma we have. And the problem, I think, in politics is not the radical economic transformation. It's whether Ramaphosa is willing to give a decisive lead in trying to get the situation resolved. Perhaps I should leave it at that, and see if there are any questions.
Sandy, thank you very much indeed. Can you hear me? Just want to make sure.
Yeah, no, I hear you well.
Great. Thank you very much indeed for that fantastic trip around the world and conclusion on the South African environment. One of the questions that I have for you is to start with on the international side. You mentioned that there is pressure on the Fed to taper. And you also mentioned that China is moving toward a slower rate of growth going forward. So if we take the combination of those two, pressure on the Fed to taper as well as Chinese economy slowing down, what implications does that have for commodity prices and this tremendous windfall that we've enjoyed over the last, say, 12 to 18 months?
Right. Now, first of all, just to talk about the link between China and America. My view on this is that there are actually only two countries in the world left as a result of globalization. One country is China, and the rest is the rest of the world, which is more or less an integrated system. But China is very much doing its own thing behind an exchange control wall and a regulatory wall and so on. And that wall has been increased. You know, the Great Wall of China is going higher, not lower. So you can get things happening in China which are totally, different to what happens elsewhere. There's a huge pool of savings in China which is locked into China, for instance. So China can very much go on its own way. Slower growth in China will mean there's less imports. They will go to more. They're aiming to go for more domestic production. They sound just like Patel on a bad day, and they're trying to replace imports. But the way China's going is it won't be needing the rest of the world as much as it has in the past. And what it needs is raw materials, which they'll continue to import. But its growth will be slower. And that will be nothing to do with what happens in America or anywhere else. It will be internally driven by China. It will go slower. Now, the rest of the world is on a dollar system, and the dollar is the reserve currency for the rest of the world. And what you've seen now is the surge of inflation in America is what's putting pressure on the Fed to taper. The impact on growth in America is growing incredibly strongly, and what you see is a very large amount of investment happening. investment, corporate business investment has risen enormously. It's the highest level been in decades. Companies are spending money, especially they can't get labour. So they're investing. So you've got a large amount of investing in America, and also a large amount of investment in productivity and growing the economy through productivity. So the underlying growth path for America looks very positive. And to a certain extent, the world was only being driven by growth in China. Now growth in America has become an important part of the equation. And this growth would normally in America require high interest rates, but it doesn't mean that the growth doesn't happen. High interest rates do not prevent economies growing, really. It's productivity which makes economies grow. And America's going through a productivity revolution. And so you can have fairly strong growth in the rest of the world for a year or two as we sort of sort things out after the pandemic, and investment is high. And that basically is a favourable market for commodities. China's slowing is to a certain extent, not totally, compensated a bit by growth elsewhere. The other thing that's happening which affects inflation and growth tremendously, which I haven't mentioned, is the world's embarked on a project of decarbonisation. Now this project has not been costed at all. It's just a target, and how we're going to get there, no one knows really. They're saying electric cars, this and that. But what you're doing is replacing a carbon-based economy by a electrical economy. That's what the whole project's about. And that's going to require huge investment again. It requires a lot of resources. So the problem with the decarbonisation is it operates totally in the opposite direction initially of efficiency, because it's a much more costly technology. You have to build it to start with. You have to replace it by something that exists for 100 years, hundreds of years, and doing it in a mere 10 years is going to be, without very serious sort of unintended consequences, is just not going to happen. Especially a large amount of the world's savings are going to be distorted and sent into that project. So the trouble we have, especially in Europe but elsewhere, is globally. You have an aging global population, and a population for which the savings for retirement are clearly inadequate everywhere. So now you say, on top of that, we don't want to only pay for people's retirement for their medical costs, but we want to also change the whole world economy. Of the same savings pool, the demand on the saving pool is going to be astronomical. So it all comes together as actually an environment where there can be quite strong demand for a whole years to come. It can be, there are going to be, chops and changes on the journey, but the underlying trends could be quite strong demand throughout the world, and quite a large investment in productivity in business, and quite a large calls on the savings pool. And it's not an environment which basically could be persistently inflationary. But it's not an environment where, in fact, the world is not going to be an unfavourable one for business. It could be quite a good business, right? And that then comes back to the view that in the longer run, the view on equities actually is quite a favourable. They look crazily expensive, but maybe they're less crazy than you think.
Great, thanks very much for that, Sandy. I've got another question here from one of our clients saying, you suggested that the Rand should be stable at current levels. I'm surprised about that given our fiscal deficit and difficulties that we have in the South African economy.
Yeah, the Rand is a matter of flows. There are two types of flows. There's trade flows, which I've shown it clearly now. I mean, we've never had for 20 years a big current account surplus. So there's more money coming into South Africa than going out. And interestingly enough, the Reserve Bank, from the trade side, that is, and the Reserve Bank has actually increased our reserves slightly. But what they've done is when the government has raised foreign money, they've tended to hold more of that offshore than they would have otherwise. And the reason is they don't need the money here. They don't want to push more money into a money market which is actually flush with liquidity. And there's a lot of liquidity in the market. The The deficit is a question of how you finance it. And, if you were, what you've seen is that the financing of the deficit was being done about 40%, 35% by foreigners, and 2/3 by us, say 1/3 by foreigners. And when we were kicked out of Whigby last year, there was a major sell-off of South African bonds, and where we previously we'd had 40% foreign ownership of our our government bonds, the vanilla bonds. This went down towards 30%, and what was taken up by the banking system. It wasn't. The pension funds and asset managers have been buying more, but the percentage of ownership of these as a percentage of total has not dramatically changed. The thing that's barely changed is so much that the government has taken. The banks have taken a very large part of what was dumped by foreigners last year. The banks now sit with probably more bonds than they feel comfortable with, but that's how they were financed. Now, going forward, the question of financing the government comes as, can we do it from our existing savings pool? And South Africa has an advantage, is that we have a very large savings pool. Officially, the actual number is about 9 trillion rand, and these numbers are yours all over the place because there are things like Naspers ownership of 10 cents in there and that sort of thing. But how do you look at it? We have a very large savings pool, and you can say, well, how do you finance this government bond? We have let's say 8-9 trillion sitting on the side. That's all our money, by the way, to get it exactly. We must think of it very clearly, our money. And what you can do is, if you want to run a deficit of say 300 or 400 billion a year, well, you can go on there for say 20 years until all that runs out. So what you're going to see is that the government is funding itself by tapping into that savings pool, and the holders of the savings pool don't want to hold it there. A lot of us want to hold foreign assets. We want to own shares and so on. So in order to get money, the government has to pay up, and that's what you're seeing. That's why we're at 9%. So it's really the high interest rates are a product of what the government has to pay to get money from the existing savings pool. That's where it comes from. The rand has not got much. We're not getting foreign money in the same way as we used to. The previous years, in fact, the Zuma years, funnily enough, were largely financed by foreigners buying our bonds. Now that we're good, we don't know. We're not getting that privilege anymore because the world's changed, and people look at the numbers and they don't like them.
Thanks, Andy. Just one more question here from a client who's saying, what you said is in order to sort of resolve the fiscal deficit, the solution is to grow the economy. Are you optimistic that government and private sector will be able to partner to grow our economy at a significantly greater rate than we've seen in the past?
The answer is no, but maybe that doesn't matter. Because the truth is, this government, the ANC, is the biggest problem Ramaphosa has. Is Zuma has gutted the skills base of government. There aren't people in government who are really competent of playing such a role. And the Treasury is a shadow of what it once was, and other departments have all lost their skills. So it's going to be very difficult to get anything sensible, do anything sensible with the government, because there aren't the people there to do it. You need people on the ground to make things happen, and they aren't there. So the government is going to be missing in action because it doesn't have the people to do the things. Ramaphosa, we're famous for our plans, we've all got the plans and so on, and everyone talks about needing cooperations in the government and the private sector. But actually what's happened since the ANC has been around South Africa's growth has been driven by the private sector, especially if you look at the period between 2000 and 2012, when the economy actually grew quite strongly. It was all due to the private sector. The private sector took the export windfall and invested it. You know, in those days when you used to always share your house with a builder because you was building something on, and all that sort of boom, always financed by those capital inflows came in. Actually, it wasn't so much, and it was the huge trade surplus together enabled us to grow. So South Africa grows, only going to grow if the private sector takes the lead. And to do that, you need demand in the economy. You need demand, and the moment any demand really the private sector can find is in exports, not domestically. But these things correct in time, because if the parts of the private sector are doing well, then they start. If you're working in the platinum mines. You know, a few years ago, Rustenburg was a disaster time with the platinum industry almost closing. And Spitz in Rustenburg is one of the best barometers of the economy. It was, disastrous. But now the platinum industry is all booming. People are getting big bonuses, and they're spending money. So the people who work in the bits of the economy that are doing well are going to spend money, and as lockdowns end and there's a degree of normality comes into our lives, people will spend money, and the private sector it can't create a great outcome, but it can create an outcome which is not better than people expect, and that is, I think, why this export boom is so important in getting this economy going again. It's going to make the private sector grow. The government, doesn't matter what the government does. You've got to think, if anyone reads Harry Potter or read their children Harry Potter, they would know that there was a world where there were wizards and muggles, and they lived in the same country, but neither had much to do with the other. And that's true of South Africa, really. The private sector is not dependent on the government for anything, because the government doesn't do anything for the private sector. It's notably absent. And that's the same here. We have two nations in one country, and the situation is in place where the business, as long as law and order can be maintained, which is the great weakness. These construction mafias, which, for instance, are the great obstacle to economic recovery. If they can be controlled, as long as law and order is more or less contained, and there is the environment then is quite stable, the private sector can grow just on normal things, taking its own wash and exporting and so on. So it's not a totally hopeless situation. But if you look to the government saviour and forget it, then you're going to get very gloomy, because the government doesn't have the skills to do it.
Thank you very much, Sandy. I don't have any further questions. Thank you. It's been a great privilege having you on this morning and listening to your insight. It's been fascinating. To use your Harry Potter analogy, I'm assuming that the government are the muggles and the private sector are the wizards. Perhaps we could ask Hermione Granger to come along, and she could lead us out of this malaise that we've been in.
That's who we need.
Thank you very much indeed, Sandy. Much appreciated, and all the very best.
Great. My privilege. Thanks for listening.
Cheers for now. Bye-bye.